When massive and sudden market surges occur, they violently force the underlying trading architecture far beyond its originally designed structural tolerance levels. Here in India, the National Stock Exchange processes millions of derivative contracts daily. That volume relies entirely on a predictable, static mathematical structure. Before the opening bell rings, the exchange calculates and publishes a fixed grid of strike prices. Traders then build their risk models and strategies around this predefined list. The system works exactly as intended under normal conditions. But when a shock hits the market, when Nifty or Bank Nifty gaps up by 700 or 1,000 points in a single session, the core parameters fail. This chart tracks an index experiencing a vertical price surge, pushing past its expected daily range. Look at the option chain next to it. The pre-calculated strike rows run out, leaving a blank void where traders expect executable data. At the peak of a volatility spike, the fixed grid ceases to provide new data points. This technical ceiling prevents execution in the very price zones where risk is highest. Without those new rows, the exact out-of-the-money and in-the-money strikes that correspond to the new price level are functionally unavailable to trade. This creates a crisis in the order book. Watch the bid and ask columns here. Without sufficient participants at these price levels, the columns pull apart, creating a massive gap in the center of the market. Finding a counterparty becomes mathematically improbable, forcing a spike in implied volatility. Standard risk management freezes. If you need to roll a position or execute a delta neutral hedge, the mechanics are impossible to execute. Traders are forced into a compromise. To secure any position at all, they have to purchase distant strike prices at an extreme premium. This impact is most severe for retail traders, who find themselves priced out of the market right when the most critical price action is occurring. We define this compounding phenomenon as a liquidity vacuum. The market losses experienced during these jumps are rarely due to poor directional forecasting. They are the result of a structural failure at the market's architectural limits. To address this structural flaw, the Securities and Exchange Board of India has released Retarded Regulatory Consultation Paper. The proposal introduces Live Market Addition. The exchanges will transition from relying on static grids to generating dynamic, continuously updating option chains. Watch this option chain. If the index crosses a threshold, like 26,000 shown here, the system instantly instantiates new rows for 26,100, 26,200, and 26,300. Within milliseconds, newly synthesized options populate the terminal. Notice how liquidity pools into these fresh channels, making them actively tradable. Because this injection happens at the speed of the exchange's matching engine, the liquidity vacuum is prevented from forming. This architectural shift transforms the market from a rigid grid into a fluid system that expands in real time. SEBI intends to apply this dynamic structure across the board, covering stock options, index options, currency options, and commodities. The primary benefit to the trader is the reduction of bloated extreme volatility premium prices. A continuous supply of relevant strikes naturally tightens the bid-ask spread back to competitive levels. This restores effective hedging capabilities. Institutions and retail traders can precisely target their risk management without relying on suboptimal contracts. Providing continuous liquidity natively stabilizes the overall volatility of the broader market. By mathematically guaranteeing the availability of strikes, SEBI removes the artificial panic that historically drove premiums to irrational highs. A dynamically expanding market dictates a new operational reality. Directional prediction is no longer a sufficient competitive edge. As the simple directional arrow fades out, notice the quantitative dashboard replacing it. Traders must now actively track live liquidity and volatility on a per-strike basis. This means mastering option chain dynamics, understanding the specific triggers that cause the exchange algorithms to drop new strikes onto the board. However, this infinite availability introduces a behavioral risk. Trading activity will increase. The constant generation of fresh strikes creates a psychological trap, luring traders into poor setups through sheer frequency. Expiry day scalpers face a high specific threat. Without a physical limit to the chain, they are susceptible to overtrading loops. A market with infinite strike availability shifts the primary risk from systemic unavailability toward individual trader indiscipline. While traders upgrade their models, the execution of this rule falls on the back-end infrastructure of the brokerage firms. SEBI has established a strict technical mandate. Brokerages must ingest newly generated strikes with zero manual intervention. This topology map shows a new strike packet moving instantly from an exchange server node directly into a live trader UI, bypassing manual gateways. This automated pipeline eliminates latency. The UI node pulses green, indicating seamless updates and continuous uptime, even under heavy data flow. This design addresses the systemic expiry day platform crashes that have historically plagued Indian brokerages during high volatility. It creates a closed loop running straight from the exchange's algorithm into the broker's API. Exchanges create the dynamic strikes, but the operational burden of keeping the market alive falls on the broker's server racks. The Indian F&O market is moving from a state of rigid, static vulnerability toward dynamic resilience. This transition imposes dual requirements. Traders must upgrade their analytical modeling, while brokers must upgrade their latency architecture. Currently, this rule is an active consultation paper, gathering feedback from the industry. The deadline for public and institutional feedback is set for June 15, 2026. SEBI is expected to roll out the final framework and implement the system in the weeks following that deadline. Trading on the first day this rule activates is a liability for those who haven't updated their risk strategies. The market is moving toward a sub-second response cycle, requiring a higher degree of technical precision from all participants. Success in the 2026 market requires accounting for the microstructure of real-time strike generation alongside directional forecasting.